Hello there, Simon Jackson from LearnLoads.com here. This video is about sources of finance. It's aimed as a quick guide for A-level business students in particular. This term, sources of finance, is used in exam questions in relation to the need to either start up a new business or finance a project for an existing business, such as investing in new machinery or developing and producing a new product. Sources of finance nearly always means sources of capital. Before we go on, a quick question. Is money the same thing as capital? Have a think. The short answer is no, money is not the same thing as capital. Capital is money, but nobody talks about needing capital to buy a cup of coffee or a new pair of shoes. So when you're thinking about sources of finance, make sure you're clear about the difference between capital expenditure and what's called revenue expenditure. Now, let me explain. In the business, when we talk about raising money for capital expenditure, it involves big one-off costs such as buildings or machinery, assets that we will use over a long period of time. The word capital is used in this way. Revenue expenditure is short-term finance for things like wages, the electricity bill, or other kinds of day-to-day expenses. The money needed for revenue expenditure is called working capital. You're not going to purchase a crane or new office furniture using working capital. Once a business is up and running, these sorts of day-to-day, very frequent expenses come from the revenue generated by selling products, by trading. That's why it's called revenue expenditure. If a business is having to find more capital every month to pay for wages or pay the electricity bill, then it's got real problems. It needs cash to pay for these trading expenses, not capital. Now, remember that difference between capital and working capital. Okay, just think about that. So, what are the sources of capital for long-term purposes? Well, we've got personal capital and retained profit, ordinary share capital, loan capital, and venture capital. Sources of working capital, on the other hand, include personal capital, a bank overdraft, short-term loan, or trade credit. I'm going to use an example before I go on to just explain different sources of finance. This is Leon and Susie. They're planning to set up an upmarket florist together. They'll need to start their business £500,000 capital, but they've only got £400,000 of their own personal capital, £200,000 each. Okay, first of all, personal capital and retained profits. What do we mean by that? Personal capital is the capital that the entrepreneur brings in to start the business. Okay, Leon and Susie's 200,000 each. It may come from savings, inheritance, the sale of a property. Retained profits, that's profits that's left over from earlier years that have not been spent in some way. One big advantage of using your own money to start a business is that it'll cost you less than a bank loan. There's no bank interest to pay. Ordinary share capital. Using share capital means that your business is a limited company, not a sole trader or a partnership. They can't use shares. A limited company. If you're unsure about what that means, have a look at this Learn Loads video. Just follow this link here. Where the founders of a company put their own capital in to start up a business, they give themselves shares. In effect, share capital is what is called internal finance in this instance. So, okay, Leon and Susie are putting in £200,000 each. That's share capital, but it's still their money though. On the other hand, if the founders of a new business attract capital from other people by selling them shares, then you would call that external capital. Outside capital, external capital, is being brought in to help finance this business. The big advantage of using share capital compared to borrowing money off the bank is that shareholders are to a large extent locked into financing the business, and they only get a slice of your profits if you have enough profit to pay them. Using bank loans, on the other hand, means that you have to make regular repayments with interest, whether you're making a healthy profit or not. You're still going to pay the bank, no matter how well or badly your business is going. Disadvantage of share capital, the drawback of having shareholders might be that they have a say in the running of the company. If the majority of the shares are held by external investors, they'll have a great deal of influence over many of the important things going on within the business. There's lots more I could say about share capital, but have a look at my ebook if you want to find out more. Venture capital. Two particular kinds of shareholders are venture capital companies and business angels. Another kind of venture capital is what's called crowdfunding. The advantage of venture capital is that venture capital companies and business angels, when you get those kinds of people involved, the entrepreneur can benefit from contact with investors who've got experience and expertise from supporting lots of other businesses as well. So they might, not only are they providing finance, they might also be a helpful source of advice. Loan capital. Now, bank loans provide a fixed sum of money for a fixed period of time, repaid according to whatever loan agreement you've drawn up. A bank loan is not the same as a bank overdraft, by the way, and I'll explain bank overdrafts later on. The advantage of loan capital is that if the business raises the finance it needs from a bank loan, it can benefit from being able to retain all of the profits it's making once that loan has been repaid. Shareholders, on the other hand, will continue to expect a share of profits. A disadvantage of loan capital is that supposing the business doesn't perform as well as expected, as I said earlier, loan payments have to be made regardless. Now, let's turn to summarizing different forms of revenue expenditure. First of all, an overdraft. This means that a bank enables an account holder to have a negative balance on their bank statements. That's what it boils down to. Okay, you can spend more money than you've actually got according to your bank balance. In other words, expenditure is greater than the money available in the account. A percentage interest rate is charged, however, if you go into overdraft. The advantage of an overdraft is its flexibility. If there's some kind of unexpected problem and you've got to spend money, then having an overdraft facility can act as a safety net, just like it does with people in their ordinary lives. If things are going well, maybe you can avoid using your overdraft too much so you're not paying interest. It's a very flexible way of borrowing money. A disadvantage of an overdraft is that banks, or rather, the bank that you've got an overdraft from might suddenly decide to withdraw your overdraft facility because it feels the business is not going very well. They're a bit worried about getting their money back, so they cancel that overdraft facility. This can mean, for lots of businesses, particularly small businesses, that they've got no working capital and they're forced to stop trading. They were relying on that overdraft to keep paying their bills, to tide them over a difficult period. No overdraft, big problems. Short-term bank loans, these can be seen as an alternative to an overdraft. Obviously, we're just talking about borrowing the money for a shorter period of time rather than a longer period of time. You're not normally going to take out a bank loan to buy, some £200,000 piece of equipment. You're not going to take out a bank loan for 1 month. For that, it's going to be a long-term bank loan. Short-term bank loans for smaller amounts might be appropriate. Trade credit. It might be possible to negotiate with suppliers to be allowed a longer credit period. For example, a supplier might agree to give you 60 days to pay your bill instead of the standard 30 days credit. If you manage things well, you don't have to make payment for what you bought from that supplier and you're reselling until after the goods have been sold. This means you need less working capital tied up in your business. So you've got no extra money in one sense, but trade credit, the clever use of trade credit, is a way of reducing the need for working capital. Hope this helps. This video was based on part of one of my ebooks. Click on the link just here to find out lots more detail about sources of finance and everything else you need for A-level business courses. If you found this video helpful, please subscribe to the Learn Loads YouTube channel and have a look at my channel. There's lots more where this came from. Thanks a lot. Bye.